So it's been just 11 years ago that I started talking about the super cycle, started talking about what was driving the secular bull market. The Dow at that time. The first radio program was on February 3rd, 2012. That's just 11 years ago. The Dow was at 12,862. Now it's almost tripled that. So does the super cycle still hold? I said it was going to go in probably to the 2030s. So what is the super cycle? I used to talk about it almost every quarter. Now it's been a while since I've talked about it. Super cycle was a study was done by Standard Chartered Bank out of the UK, 1,700 branches, 80,000 employees. And they did a study showing that there were periods of time, long periods of time, when the world GDP grew faster than average. The first supercycle started in 1870 to 1913, was 43 years long. It was driven primarily by the industrialization of the United States. Doesn't mean that there weren't financial crises. There was the 1874 financial crisis, no bailout, 30 years of pain. Very similar to 2008, except the pain continued to go on for years. Agriculture, at the beginning of that supercycle, 50% of the people were living or working on the farms. That changed as people began to move into the city. High unemployment. We didn't record the numbers at the time, but it was probably 20% employment. People moved into the city. People began to start businesses. A very powerful growth period of time, not in agriculture, but in business. Difficult business cycles, but the United States during that period of time, from 1870 to 1913, emerged as the world leader. London had been the world's financial capital. That began to shift to the United States. That was the first super cycle. 43 years long. The second supercycle from 1945 to 1970, 35 years. And that was a time when we came out of World War II. There was rebuilding of Europe. There was decolonization happening. The growth in wealth in many countries like the United States and the UK and France and Germany, the affluence took off and really grew during that time. It was Europe's reconstruction. Asia began to export, and we began to export to Asia. The stock market, starting at 150, grew over tenfold, almost tenfold, to well over 1,000. And it was the time of the Cold War. Those were the first two supercycles. The second supercycle that Standard Chartered Bank said had begun in 2009. And remember, this is 2012 when we're beginning to talk about it. 2009, and it was driven primarily by the emerging countries, especially in Asia. And the winners were going to be global winners. China, India, Brazil, Indonesia, Russia, Turkey, Sub-Saharan Africa, the Eastern European countries. Countries that were less transparent, less stable, and investment was significantly more vulnerable to politicians and bureaucrats, and corruption could be epidemic. But it was also a time in which we were seeing globalization, and the number of exports that were going meant that U.S. companies in the Standard & Poor's had over 50% of their sales going overseas. They were benefiting from the emerging countries, those emerging nations. Every cycle, every one, from the first, second, and the third, had their share of losers. And if you look at the first supercycle, it was agriculture. If you look at where we are now, it's going to have its losers as well. We're going to go through downtimes as we went through in 2022. That's not going to be the only time we have difficulty. And it's a time in which there are going to be companies that emerge and do very well. With that as a background, I have to say that it was interesting to read Liz Ann Summers, who is the Schwab investment strategist, saying we're in a bear market. That's something we disagree with. But she wrote an article and said that the real risk was in earning. And yet when she really talked about the article, and we do agree, there are areas of the economy that are truly in a recession, in a depression. And, if you look at housing, what's gone on in the mortgage industry, those interest rate sensitive industries are really struggling. But we don't think that that's going to be a common recession all the way over. But Liz Ann Saunders said we cannot avoid a recession. We cannot avoid a recession, she said. And why? Her justification was the yield curve is inverted. Short-term rates were 4.5% and the long-term rates were 3.5%. And she said, never in history have we avoided a recession. Might be 6 months, might be 12 months, or 24 months.
How long has the yield curve been inverted?
The yield curve has been inverted now since very close to when the Fed started raising short-term rates.
So me and you both, and a lot of people I think agree that we might have hit November.
Or maybe no recession.
Or maybe none. Right.
I mean, and
Why
yeah,
we had the 2 quarters of we had the 2 quarters of negative GD last second and third quarter.
yeah, but
We saw the S&P bottom, and we've rebounded, like we mentioned in the study.
Renshaw.
The Renshaw.
the market was up. Yeah.
It's been up, and it stayed up.
Yep.
And people keep waiting for the next shoe to fall, and they're going to look for it during February, because statistically, February is the second worst month out of September, right? So you have a great January, and then you might have an okay February. What are they going to see? I told you so.
Yeah. Well, it's interesting. I think the inverted yield curve has actually predicted 9 of the last 5 recessions.
Okay.
Actually, she's probably right that eventually there will be a recession. I can predict the weather. I've never been wrong. I can tell you that here we are in February. I can tell you it's going to snow in the future. I can't tell you the day or when, if it's going to be this coming winter or the following winter or the winter after that or the winter after that. But the chances are pretty great that I'm going to be right. And so if the yield curve inverts, eventually there will be a recession.
Wasn't she also kind of something? Several hundred companies in the S&P 500 have 20% negative, or their earnings are going to be negative.
She did.
And you and I looked at that, and we referred back to Richard Foster of Yale, his study, that the lifespan of the S&P 500 company, and I'll just read what he says. He found the average lifespan of the S&P 500 company dropped from 67 years in the 1920s to 15 years. Foster also found that the average S&P company is now being replaced, listen to this, every 2 weeks. It estimates that 75% of the S&P 500 firms will be replaced 20.
Yep.
So what are we seeing?
So, I mean, think about this. And I've used this example 15 years ago. If someone would have said to you that you will fly into a city for business or for pleasure, get into a stranger's car who will drive you to a stranger's place where you will stay the night, you would laugh. But Uber and Lyft are the stranger's car that carry more traffic than taxis now. And Airbnb, even though they've gone through their struggles, are a place where most people are staying.
Yeah.
And it's completely changed. Airbnb has more rooms than any hotel chain.
And these disruptive technologies. And so the question is asked. I did a little bit off from Foster, read some of his article. And he's like, where do these companies go when do they just go to the wayside? He said they don't. They end up being morphed, absorbed, evolved into new different companies, because somebody has an idea that to create something new and takes this company that was maybe old and stodgy and says, hey, let's make it new over there. It becomes a whole new company, whole new industry.
Or it folds up completely.
But he said his studies have shown that's not really what's happening. They're not just folding their doors like we talked about Polaroid or Kodak folded their doors because they would just miss the market on digital photography.
Yeah. So I had a Palm Pilot originally with the stylus, and the Palm Pilot then was replaced, or BlackBerry came along, and Palm began to die, and it was Compaq that bought Palm. Hewlett-Packard bought Compaq, and that disappeared into another company.
Right.
But they were never able to revive and make Palm work again.
An irony about his work is that this is kind of an American thing. This is a unique thing that happens in America, the S&P 500, because in other countries, in Europe, especially in Asia, it doesn't happen. They say in Europe and Japan, the ladder is home to some 50,000 companies that are 100 years old.
Yeah.
And so it's
some are 200 and 400 years
right.
old.
So this is a uniquely American thing. So we have to take a break. We will pick that up when we come back.
About money with your AFC team, Mike and Al, on AM 1300, The Answer. For more information, click on adamsfinancialconcepts.com.
So, Mike, before the break, we were talking about the S&P 500 and that, Richard Foster from Yale, 75 of S&P 500 firms will be replaced in 2027.
Yeah.
We left it by saying that this is not normal as far as the way the world works, as far as other countries. In Europe and Asia, companies hang around for over 50,000 companies that are over 100 years. And I think...
Yeah, I didn't realize that.
I didn't either. And I think that that's kind of amazing in a sense that why is the United States economy so dynamic, and where, people like Ray Dalio say that, China is going to replace the United States. If that's their mentality of holding on to companies that are so old, where we're willing to let things go and evolve and change all the time, that's a huge competitive advantage.
I agree with, and it makes me think, geologists can look at 1 billion years of historical data and form models of how the Earth, and that doesn't change. Meteorologists, the same thing. Doctors with kidneys, they operate the same way in 2023 as they did in 1023. That's the way it is. But investing is an art, and companies that are operating are dynamic. It completely changes, and it changes year by year. I think J.P. Morgan did a big study on stocks, and they found that from 1980 to 2014, 320 of the stocks in the Standard & Poor's have been replaced. 320 out of 500. That's 70% of the stock. And those are stocks, and the 320 were not companies that were merged out of business, that were not combined. They were companies that lost money or their stock prices dropped so dramatically. And so the index is really driven by 30% of the companies when you think about it.
Yeah, so looking at, they did a study, 25,000 companies from 1950 to 2009. The group researched, employed mathematical models from theoretical ecology to look at the lifespan of American companies. They found that publicly traded companies die off at the same rate regardless of firm's age or what sector it's in. In the data set, they found that most firms live about 10 years, and most common reason they disappear is due to merger and acquisition.
Yeah.
That's interesting. I did not know that.
But I think a lot of them was that are merged out of business, just like Palm was merged out of business, but it was a dying company. You can look at any number of companies which have gone under. They didn't go under. They didn't go bankrupt. They were bought for whatever reason. Compaq was bought. Gateway. You can go down the list of companies. Radio Shack, Blockbuster.
Right.
They tend to be bought by somebody.
Yeah, but I think like in the tech space, in biotech space, those companies tend, if they have a viable product but just can't seem to get a lot of funding. And I was talking to a friend of mine that they have a cancer diagnostic tool that basically if somebody comes to them, they can pinpoint the genetic markers if they get the cancer cells early enough, and they can diagnose and design a treatment specifically for you or for me. However, what she said is they can't find funding. They've laid off, I think they're down, she said they had I'm just going to make up notes, but they had like 200 something people. They're down to like 19 people. They can't get funding. Their technology shows efficacy, and they can't get funding. And
that's, I think we've had some people on as guests that are from accelerators, and you see Seattle must have over 10,000 software companies today, and only 1 out of 100 can get. So funding is a different, either you come up with bootstrapping it up, or if you're one of the lucky ones, you get some round to fund. But it's a difficult thing.
It is. I mean, another guy I was talking to, I think I mentioned to you before, they're trying to grow fish in a lab because the depletion of some of our main species fish, particularly salmon. And he's, same thing. He said, well, we try to keep getting funding to see if we can, it shows that they can do this, but to get the funding to actually do it is a different ballgame.
Yeah. So it seems like there's a lot of funding out there, but the reality is there's a lot more companies looking for funding is available.
And especially when we go to these, times right now where these VCs of venture capitalists might be pulling back slightly because everybody's screaming recession. They don't want to spend money. They'd rather hold their money right.
Well, and the VCs are also faced with an issue. They invest in a company, and if the company struggles some, they'll oftentimes invest more. But eventually they want an exit out of that company.
Right.
And so they have to have a very robust market to get out of IPOs. And we're not seeing a robust IPO market.
No.
So they've got their money locked up, and it's dead money sitting in companies they're waiting for an exit from.
Right.
And so VC funding is difficult. Crowdfunding, which I thought would really replace VC funding, has not taken off to the extent I thought it would. And yet what we've seen is in America since COVID or during COVID times and since then, we've seen the most rapid small business formation we've ever seen in history. It's just phenomenal, the number of businesses that have been formed. And some of those will be the businesses of tomorrow.
The analysts keep banging on the drum of, all the layoffs that have happened. And you and I have been over this on several other shows, that most of this is normal. A normal attrition. These companies do this all the time. And moreover, during COVID, they hired like crazy.
They did.
And I wasn't really thinking about it, but talking to a potential client that I've become friendly with, and he was an old actuary with the FTC, and he says, well, Al, during COVID, these companies hired like crazy because they were getting this PPP payout, and the more it's based on the number of employees you had. So they had all this money coming in. Why not just keep hiring? And so now I've realized we don't really need this. We got to lay them off.
Yeah.
So.
And yet, even though they're laying people off, the people aren't spending much time unemployment. They're going from job to job to job. 47 million people quit their jobs last year.
Yeah.
And if you look at how incomes have been rising, a good percentage of wage increase has been people moving from one job to another. You think of the days of the 1960s and 1980s when wages were increasing, maybe not so much the 80s, but the very early 70s and the 60s when wages were increasing, when you had inflation going on. You had a lot of companies that had strikes going on because people were demanding higher wages. It seems today you don't read much about strikes. Instead, you read about people quitting. They quit their current job to take another job at 50 cents or 75 cents or $10 more an hour. And with there being 4.5 million jobs more than there are workers, that's going to continue to be a headache.
No, especially in the service industry. I was talking to a restaurant guy, and he said, one of his managers left because someone offered him such a high. He said, I'm not going to compete with that, right? They offered him to manage their other restaurant a lot more money.
Yeah.
And then another person left and went to work in Nevada. They didn't get a pay increase, but the cost of living is so much less. It was like a huge pay increase, So
I remember overhearing a conversation not too long ago. Somebody from a restaurant was saying they had to hire a busboy and they had to pay $25 an hour.
Yeah.
Minimum wage $15 to get a busboy to bust the dishes off the table, to wash dishes. $25 an hour.
That's why it's like some of the restaurants that I go by and I see that they haven't opened up their seating again for people to eat inside the restaurant. They were making money with the lower staff, no dishes to clean, no busboys to hire, right? Why go back when people just take the food and go eat it wherever they want, at home or at the park or in their car?
Yeah. So the world is changing. We talk a regular theme of the changes that take place because of technology, demographics, and lifestyles. We're living in that period of time. Lifestyles have truly changed. People don't want to go to the office. They want to work remotely. Service industries, we're seeing the change in robotics. We're changing. Technology is allowing so many changes to happen. And that means if you're an investor, you want to be ahead of the curve rather than behind the curve. You want to be in front of the action rather than behind where things are happening. That's where it is.
But we've talked about some of these companies that got too ahead of the action, right?
There have been some of those. That's part of the risk of,
yeah.
You don't want to be way behind the curve. You don't want to be too far in front of the curve.
No, but you and I both remember the .com boom, right?
Yes.
And a lot of those, we talked about this Tom Brady's first Super Bowl, right? How many of those companies are alive today?
So the ads in the Super Bowl for Tom Brady, I wrote it down. AOL, Blockbuster, Circuit City, CompUSA, Gateway, Radio Shack, and Sears. So as we left off, we were talking about the Super Bowl and Tom Brady's. We picked up that list from Annie Duke's book called Quit. But if you look at it, Tom Brady won his first Super Bowl in 2002. 19 years later, his last Super Bowl. And if you look at the ads in 2002, ads by AOL, Blockbuster, Circuit City, CompUSA, Gateway, Radio Shack, Sears, they were paying $2 million for a 30-second ad. Today, you pay $5 million for a 30-second ad. Plus, you pay the agency cost, plus the digital expense. And if you think about those companies, who exists today? AOL, Blockbuster, Circuit City, CompUSA, Gateway, Radio Shack, Sears, they're all essentially gone in 19 years.
And Tom Brady just recently retired. He beat the average, though, Mike, because the average, you know how long the average quarterback lasts in the NFL?
No.
4.4 years.
Yeah.
It sounds like almost how long the average company lasts now in the S&P 500.
So, when you think about it, I sometimes use the example of 1966 and the blue chip companies. There was a time in which financial advisors, stockbrokers in those days, would say you just have to buy a stock, put it in a drawer and hold forever. And if you bought the 1966 blue chips, you bought Anaconda Copper, American Can, American Tobacco, Bethlehem Steel, Chrysler, General Foods, Goodyear, Johns Manville, Owens, Illinois, Swift & Company, Sears, Texas Corp, Union Carbide, U.S. Steel, Westinghouse Electric, and Woolworth. I'm not sure that my grandchildren even know what a Woolworth is.
I still remember Woolworths where I grew up. With the counter.
At the counter.
It had the
nickel and dime store.
Yeah.
I mean, most people don't even have a nickel and dime anymore. They talk about a dollar coin.
Yep.
I mean, think about it. The companies, copper, steel, that was 1966. That was the bluest of the blue chips. And most are gone. And when you think about companies that didn't exist in 1966, I mean, McDonald's came public in 1966. But you didn't have Microsoft or Intel or Walmart or Home Depot or Bell South. You didn't have, I can go down the list.
IBM.
IBM has been around for a long time.
A long time. Yeah, they've been part of the Dow for a long time.
Yeah.
There's a couple companies in there. When we looked at that last time, there's several companies that have been there a long time.
GE was there from the very beginning until recently.
Until recently, yeah.
Kodak. I mean, the companies that were part of the Dow and disappeared. But the companies that, I mean, Starbucks, Genentech, Amgen, Qualcomm, Cisco, Salesforce.com, all those companies came afterwards. And you have to wonder if they're not at the peak of their evolution and are going to be replaced.
Well, that's interesting because when you talk about Intel, and the reason why I say that is because we've talked before about the chip industry coming back here, and specifically Intel getting a boost, building I forget where they're building a new factory. Was it Ohio or somewhere around there? Ohio. And because the new, we saw these, like we talked about the dot-com bust, right? But now the new thing a few years ago was blockchain. Was everybody was investing in the blockchain, and blockchain mania, right? There was a Long Island iced tea switch from branding it to Long Island Blockchain Corp, right? These things to build hype around their brand, and we saw it in the
dot-coms. I mean,
the dot-com, but the cannabis was hot for a while too.
Cannabis was hugely hot. 2019, the Money Show, the booths for cannabis were just overflowing with people. They couldn't go in. I kept thinking maybe it would go up in smoke, but anyway.
Cheech and Chong reference. You talk about risky stocks. Those ones seem particularly more risky to me than anything else.
Oh, yeah. And remember, the Super Bowl advertisers, I think there you really get a picture of the companies, which are the companies that will bust. It was just what?
But the cannabis, they trade on the OTC, the over-the-counter market. I didn't know this. So they're not required to file regular financial statements or maintain minimum levels of market capitalization. That's completely different than a company that, I mean, don't get me wrong, a fraud's a fraud, that trade and have to file those 10Qs and 10Ks where you can actually get an idea of what's going on with the company.
Oh, yeah.
Unless you're Enron and decide refuse to put the off-balance sheet transactions on your balance sheet.
Oh, and they refuse to release the balance sheet.
Yeah.
So anyway, no, I mean, remember, it was only, was it last year when we had the cryptocurrency?
Yeah, FTX, just 6 months ago. FTX and the ones that went bankrupt. There were several more, but I can just name off some of the big ones. Of course, everybody knows FTX, and we'll bring up Tom Brady again, and Genesis, and I think Apollo, or a couple of the big failed crypto.
Yeah.
What do they call them? Exchanges.
Yeah.
And then Binance, which was the big one, a real big one, and they were worried about Binance would collapse, but Binance, they stopped letting people take no distributions. They froze taking any distributions from the company.
So they were all paying $5 million for a 30-second ad on the Super Bowl last year.
Yeah.
So
that's we did one of the previous shows on know when to hold them, know when to fold them, know when to walk away, know when to run. When you see the Super Bowl ads, that's when you run. But the new one, Mike, coming up now is hot as a pistol. Is anything with AI in its name? I told you if you change Adam's Financial Concepts to Adam's Financial AI, see what happens.
We would go public.
Yeah, I don't have to go public. We just change the AI.
Fly through the roof. No, in each of those, I can remember I was really early in the internet. I started doing internet stocks in the mid-90s. And the reason I did is because I looked at Microsoft, and because computer memories were doubling every 18 months, that meant that a company like Microsoft could write script and double the amount of script every 18 months. And the speed at which Microsoft was growing in those days, because they could add more and more script to their programs, was phenomenal. And I looked at the internet. The internet by the mid-90s was doubling every 6 months. Computer memories every 18 months.
Yeah.
The internet was doubling every 6 months. And I said, this is going to be a huge thing. What became an issue is people started thinking about computer real estate. How much how much space you took up on a computer screen. They began to talk about page hits. They began to talk about non-economic value. Instead of revenues and earnings, it became all about the real estate on the screen, all about the page hits, all about things which didn't generate any revenues. And so I ended up being out of the stocks. I owned Mosaic, which became the script for Internet Explorer, and UUNet, which became Microsoft bought UUNet to be the backbone of their internet. But by 98, as everything was flying, I was looking for somebody that was going to make money from what they were doing. Even in those days, Amazon was just pouring out money, losing money. And people were just pouring so much money into it, just like the cannabis, just like the Bitcoin.
Just
stuff.
like the AI stocks today.
AI stocks today. You know, when it comes down to it, unless a company has earnings and revenues, there's not a reason to own it. Because until you generate revenues, things don't go anywhere. Exodus Communications, I can remember by First Union, they had an A1 rating because they were so good. Because it was simply by market cap. They had no earnings. They continued to raise money to fund the company by selling stock. And a company either earns money to grow, they borrow it, or you sell capital stock. And when the dot-coms busted, you couldn't sell stock anymore. And they were losing tons of money. They weren't going to be able to borrow money. Exodus Communications went from one of the highly capitalized multi-billion-dollar companies to bankrupt in less than 12 months. I mean, people didn't pay any attention to the fundamentals. They just looked at it, and the stock price was going up, 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 and the momentum players were there pushing the stock higher and higher. The tactical players were saying this stock has so much volume and so much price increase, you have to own it. Not me. I mean, I was out of all those. And yet you could see, and the same thing is going to happen with AI and probably with cryptocurrency or crypto blockchain stuff.
Well, some people are saying the way to play AI is the chips. So we talked about Intel and some of the other stocks that make the chips because they're all driven by those chips. Without the chips, AI doesn't happen. And so, McKinsey did a study here and estimate that AI-led growth cycle semiconductors can capture 40 to 50% of the revenue pie. AI-based technology will represent about 20% of all revenues by 2025.
We're going to come back and talk about that right after this commercial break, so don't go away. This all has implications for investing. We'll try to tie it together as we finish this program this week. All right, so we were talking, and now you raised the question about maybe the way to play AI is in the chips. And I think it's always a question, do you do hardware or software?
Well, that's the thing is that this study, I don't know how much validity we can put into it, but they say the percentage should increase over time. That means the percentage of chips used in AI, the semiconductors will generate 40 to 50% of a much larger TAM.
But the question is always hardware or software. I can remember 1986. IBM had a program called OS, operating software. There was another company that had what was called dirty operating system, or at least that was the rumor. It was called DOS. People said it really was called the dirty operating system. IBM had a chance to really push their OS or just let some little software company do it. And their decision was, we're in the hardware business. That's where we make all the money.
Right.
We never make much money on our software. So we'll just let that little company go ahead and do their DOS.
That little one from Redmond, Washington?
Little one from Redmond, Washington.
Yeah.
Which, of course, is Microsoft.
Yep.
And the software became the real winner. If you look at all the software companies that have grown from that, I mean, you had Microsoft, you had Oracle, you had all those companies that grew up. And yes, there were companies in the hardware side, like Intel, we just talked about, Advanced Micro Devices, IBM. But it was the software companies that took advantage of the hardware, because once you have a little software, you can really make things grow. And you need, chips are specific. Software is easy to change. Chips have their single function. I mean, so, there'll be places to play in the hardware, but maybe software is where to be. That's something that is still not clear, but it's certainly worth looking at and understanding and knowing that the blockchain, AI, AI, all that is going to be a technology which revolutionizes technology and revolutionizes the way we live.
Well, yeah, and you throw the meta universe on there and quantum computing and the confluence of all these ideas put together. What's going to come out of that? Who the heck knows?
And there's going to be companies that rise, as Foster said. By 2027, the companies, 75% of the companies will be gone?
We'll be gone. Yep.
And we're not very far from that period of time.
Only 3-4 years away.
And there are companies which will rise so very fast. I used to use the example of Microsoft took 14 years to go from zero revenues to 1 billion. eBay and Facebook took 7 years to go from 0 to 1 billion. Zynga took 4 years to go from 0 to 1 billion.
What has Tesla done? They've gone from 2009 they went public, and they're blown.
And Tesla even faster.
Fast, yeah. I mean, in 14 years, they've gone that to, they were $1 trillion company, now they're about $600 billion.
Yeah.
In 14 years.
Yep.
So,
I mean, those things are happening. And who would have guessed that a car, an electric vehicle car, would have the kind of sales that it did?
well, and we talked about early in the show about, worldwide GDP rising. And, the growth is going to be in like India and China. In India right now is spending, I think in 2021, they want to spend $1.35 trillion to build their infrastructure.
Yep.
And they're going to be the most populous country in the world in the next few years. And they have a young population who's going to want to drive an electric car. They're not going to want gas guzzlers anymore. And they're building all their infrastructure is going to be hydrogen and renewables. They're not even pumping in natural gas.
The world is changing, and the investment side is changing. And it's important to be ahead of the curve than behind the curve. And it's going to be even more important as change happens faster and faster. That's where we are. We've talked about it. I mean, we talked about the Tom Brady example. 19 years, that's a long, long time in the life of a company today. Think about the companies that emerge. And it's not a broad swath of companies. 70% end up kind of trailing off and going nowhere. It's that 25 or 30% which maintain and continue to grow. But of that 25 or 30%, it might be only 10% which really have extraordinary growth. I mean, if you look at the FANG stocks, and we didn't own any of the FANG stocks, but if you look at the FANG stocks, they generate most of the return, a good portion of the return, 75% of the return of Standard & Poor's.
Yeah, it's a market cap weighted index, right?
It is.
And so the big companies, the returns are not going to be representative of every company, just the ones that are bigger that do really well.
And it also brings us to a time in which the people that have done passive investing with index funds may have some real problems. What the Schwab investment person said may have some validity, that we may have a rolling recession where different industries go through different difficult times. And so being in an index is probably not going to be the right way. I like to go back to what Mark Twain said. He said, put all your eggs in one basket and then watch the basket. And if you look at the people, Buffett and Templeton and Price and Fisher, they did put their eggs in one basket and watch the basket. They didn't do a little of this, a little of that. They didn't have 300 stocks in their portfolio. Lynch called it diversification, not diversification.
But he did have 1,400 positions, though, didn't he?
But he had 1,400 positions, yes.
Didn't the saying was Lynch never found a stock he didn't like?
Yeah, but he spent an enormous amount of time, so much so that after 13 years...
He was burnt out. He was done.
He was so burnt out.
Oh, yeah. Stories I'm going on vacation and driving somewhere, and his wife saying, why are we stopping here? And he had to go visit a company.
Yeah,
so
that's, it's all about technology, demographics, and lifestyles. And our life is changing. We're going to see more robotics. Robotics are going to be a key factor. Combine robotics with AI and blockchain. That's impressive. The physical world is going to change, But I think it's back to the Mark Twain thing. Put your eggs in one basket and watch the basket. Look at the fundamentals. Look at where things are headed in the future. Be in those things which actually have a lifetime of 7 or 10 years left. They've already established themselves as being as a high growth, and be there. And if not a lot of those companies, you should have some of those to drive the portfolio. We have inflation, and we believe that inflation is here to stay for a while. So you need to have a significant growth in portfolios. And if you're not seeing that growth in your portfolio, if your portfolio is down, as you listen to the program, if your portfolio is down, doesn't it make sense to look at the track record of the person that's managing your portfolio, the financial advisor. If your financial advisor doesn't have a track record, how do you know where you're going? I mean, one of my favorite philosophers was Yogi Berra, the former catcher of the New York Yankees, who said, if you don't know where you're going, you're going to get there.
You've been listening to About Money with registered investment advisors Mike Adams and Al Souza. If you'd like more information about what you've heard today, or about AFC's investment philosophy and strategy, or if you'd like the AFC team to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1300, The Answer.